While we try to be as helpful as possible, this podcast should not be considered as professional or financial advice. It contains general information only, and you should seek out professional advice for your own personal circumstances before making any financial decisions.
Welcome back, guys. I'm Gioia.
And I'm Nick.
And I'm Gioia.
And this is the Enthusiast Lab. Alrighty guys, welcome back to another episode of the Enthusiast Lab. Today we have special guest Gioia from Oui Finance.
Welcome.
Welcome. Thank you for coming on board. And Maddie's Gioia is we were talking about Maddie just before. Gioia is going to be running us through the history of interest rates and all things interest rate related.
Bits and bobs.
Introduce yourself please.
Who the fuck are you?
So my name's Gioia. I'm the director at Oui Finance, and one of the brokers at Oui is the lovely Madison, who deals with all of your clients.
Yes.
And I'm sure they all love her as much as I do.
She's a weapon. She's a
absolute
fucking
legend.
weapon.
Yeah.
And all our clients love her.
Yes, we love her at Oui as well. So yeah, she's one of the brokers at Oui. We've got a good team there. We've been around for almost 3 years now, but I've been in the industry for 10 plus.
Yeah. Wow.
Pretend I'm 10 plus 2. I was like, since I was 18, so it's 10 years plus 2 years.
Yes, 10 years plus 2 days.
A little bit more. Between house sales, land sales, and now finance, which I absolutely love.
Yeah, wow. So like a whole variety. You've basically gone from the front end all the way through.
All the way.
Yeah.
Yeah. Always been really centered around first home buyers, second home buyers, but just, mainly trying to get people either out of renting and into their own home or that like first, second home upgrade.
Yeah.
But a lot of young buyers like millennial Gen Zs trying to get them into the market, which is probably what I'm passionate about most.
Yeah.
In
finance. And you said that it hasn't always been in finance. You've also worked in the land aspect. You've worked really closely with builders. Like you've kind of dabbled in almost all the bits and bobs.
Cycle. Yeah.
Well, it's actually really cool because then you get to see and understand from all the components rather than just like, this is what the bank says. It's like we see it from the front end and then from the land developer side, selling the land and working with agents and clients and then going, cool. Actually, the finances, now you can understand all of it. It's pretty cool.
Exactly. Yeah, and there's just so, especially with building, there's so much that goes into it. It's not just, hey, what the bank says and then we order a val. Like people are putting so much into designing their home, getting all the things that they want. How can we tailor the finance to make sure they can get what they want at the end? It might just be a few different pathways to get there finance-wise.
Yeah, killer.
Yeah, and definitely because you've got so much experience like industry wide, it's great that you can pass on that information to your brokers because Maddie's come in and I think she's such a weapon because she's had such good guidance.
Really hyping me up. Thanks.
We're going to just keep fluffing Joy up in this, right?
Keep going.
Why don't you fluff me up with my shit?
Fuck, all right.
Fuck. I'm just going to start levitating soon.
Okay, let's jump in. So we're going to be talking about interest rates. That's the whole idea of today's topic. And whilst Nick and I have done our mortgage brokering degree, definitely better to leave it someone who's actively in the industry, actively, writing loans and talking to the banks and everything like that. So better from the horse's mouth than from us.
Yeah, especially because you also run, like with you running with Finance, it's not just like one broker behind you. You've got quite a team and all women like empowering each other and just smashing fucking goals, like really setting a whole different bar and just annihilating that industry.
Thanks. Yeah, and we really try to promote. I feel like you go to school, you go to uni and whatever, and you don't even know what a finance broker is or that opportunity is there. So with the team that we've got, really trying to create pathways for people, whether it's in admin or whether it's writing the loans themselves, to have that pathway to be like, oh shit, I can actually be a finance broker and help people and make a career out of it. And it is a good job for females because it's flexible. You can work from home, but you can really be your own boss and like have your own trail book and have your own client base, which is awesome.
That's awesome.
Definitely.
Yeah.
So start off at the top and let's break it down really simple for the listeners because I think a lot of people don't understand really what are interest rates.
Okay, good question. So interest rates I feel like there's always quite a negative connotation with it because you think, oh, I'm getting charged this amount by the bank, which is true. It's really a percentage of the loan that you're taking out, and it's what the bank is going to charge you for borrowing that money.
Okay.
So you're not just going to borrow dollar for dollar from the bank and that's it. As you're paying it back, there's going to be a percentage of interest that you're paying on top of that. And that's the fee that comes with borrowing $500,000 on the spot from any bank. But the flip side of that is you've got a savings account with multiple banks that have a good interest rate that you get money back on that interest as well. So there's that flip side of, yes, you're getting charged on getting a loan from the bank, you're paying interest on top of it, but you've also got high earning interest savings account as well, that bit of a reward for saving too.
Yeah, okay.
Yeah.
And that's calculated yearly, is that correct?
So the interest rate, the way it's calculated is you've got, which I know we'll probably go into, but you've got what's called a cash rate, which is what a central bank, like our central bank in Australia is the Reserve Bank of Australia, the RBA. They'll set a cash rate. The banks will then charge an interest rate, which is going to be a bit higher than that because the banks need to be profitable as well. And then that rate will be charged on the total lump sum of money that you borrow.
Okay.
Yeah, so personal loans, car loans, not just home loans, they're all going to have an interest rate attached to them, whether your loan term is 30 years, 5 years, 7 years, whether you pay your repayments weekly, fortnightly, monthly. Not many people pay them yearly, but yes, that's what your interest rate is going to be charged on.
Killer. Because that's basically how they make the money. Like
it is. And look, when the interest rates are high, obviously a lot of us are like, damn, I'm paying all this interest to the bank. But at the same time, you're able to borrow such a large sum of money to fund a house, a car, personal loan for a holiday or something like that. You've got to expect you've got to pay a little bit of interest back on it.
You got to pay for something that you don't have.
Yes. Yeah. Same with credit cards as well, all going to have interest rates attached to them.
Yeah, definitely. So you said the RBA is who determines interest rates. And did they tell the banks that they should be, charging X amount of interest rate on a mortgage, or does the bank determine their own rate? Who sets the interest rates?
So the bank will all of the banks will set their own interest rates. But before that happens, you've got the Reserve Bank in Australia that will set the floor line, like cash rate of this is where it's at. And they set that rate based on economic conditions. So what's our employment rate looking like? What's inflation target? Is it in line with where we want it to be? Do we need to stimulate the economic growth like COVID, for example? What levers can we pull to be able to get our economy absolutely humming? And then once they set the cash rate, you've got your big four banks that we know about and all of the other banks as well that will then come in and go, right, we're going to set our interest rate based on that. Usually you're probably seeing around a 2 to 3%
difference.
Difference between the two. And every bank has a slightly different interest rate, and it's based on that bank's profit and loss balance sheet, what they would like to charge. But you're never usually going to see a huge difference between the major fours, to be honest with you, because they're all competing for business. They're all competing with each other. Some of your smaller tier banks that you might hear of, like your Macquarie, your ING, your Suncorp, they don't have as big of market share. So they're trying to come in with a little bit of a sweetener, a little bit of a tiny better rate. For some clients, they can get a little bit more market share than some of those bigger lenders as well.
Yeah, okay, cool. And why do the interest rates fluctuate so much? And I'm not just talking about like this year, for example. Historically, why have they fluctuated so much? And we've mentioned this in previous podcast topics. Our parents said you need to save 20% deposit because the interest rate was 16 or 17%.
Yeah.
And then we look at COVID times when, so many people did lose their jobs and the interest rate went down to almost, 2%.
1.98 for some banks.
And now we're kind of back up to...
Spewing like didn't lock in my
rates, man. I had a client fixed for 4 years at 1.99.
Ryan locked in for 4 years.
I didn't even do that. I was like, damn. Gave that advice but didn't do it myself.
Literally, we give everyone else all this advice and help, and then we sit there and go, fuck, we didn't do this for ourselves, man.
And now we're seeing, the backup in the 6.5%, 7% kind of interest rate. Why have they fluctuated so much? Why do they fluctuate?
So it's all down to how the economy is doing, and it isn't just Australia and global. Like, for example, COVID, that was a world crisis. So not only did Australia's rates absolutely plummet, but the US did as well. So many other countries were doing the same thing as us. Historically, our parents are all saying we paid 16, 17%, but there is the argument that the prices back then and the cost of living and what they were earning was all quite relative. It is hard now. Like our interest rates are 6%, a lot lower than 17, 16%, but a lot higher than COVID times. But our cost of living is really high as well on top of that. And that is a big reason for fluctuations in the rate. You've got not just the Reserve Bank setting the cash rate, but you've got the government looking at monetary policy, fiscal policy, looking at how they can get this country in the best possible position economically. So, for example, with COVID, you've got, people losing jobs. The employment rate is not where the country needed to be. Yep. You've got businesses going under. So what the RBA says is, right, we're going to drop that cash rate. Government's like, all for it. Let's get that monetary policy into place to stimulate the economy, to ease the cost of living, to encourage people, hey, interest rates 1.99%. You should get a home loan because it's nice and easy and you can borrow that amount of money at a really low rate. But then what we saw happen was such an influx. Building grants came into place. The government puts other stimulus in the economy to lift us a bit from COVID, to stop things like a recession happening. And now we've seen last year, the aftermath last year of every month, interest rate rise, interest rate rise, interest rate rise, because I kind of picture it in my head like a lever. They're kind of pulling a handbrake on and they're like, whoa, we went way too fast, way too quickly. We need to bring it back, because if we keep going the way we're going with where inflation is, it's not under where the economy needs it to be. That cost of living is just going to keep going up. Prices are going to keep going up. It's going to be harder to get into a home. Fuel's going to go up. Our cost of living is going to go up. So it's one way for the government to just rein it in a little bit. Is by jacking up those interest rates. It's real painful for all of us, for those that have a mortgage, those that want to get into the property market, but it slows the economy down a little bit.
Yeah. I would almost say, like, the people that are going into homes now, especially since I reckon 2023 to 2024 and forwards, it is so much more substantially harder to get a loan, but also the cost of actually getting a home, they're going through a lot more struggles now to try and get through. And like, we're seeing the demographic of our clientele that, we used to have a lot more people with just like a standard 9-to-5 job, some part-time work and getting into a home. Now, man, if you're not in the 150s, 200K income, you're fucked.
Yeah.
And it's very interesting. And like, a lot of people coming out of the woodworks that were never around 50, 100, 200K deposit. I'm like, where the fuck were these people in the beginning?
Yeah. And I think what's hard as well is all of the banks, just speaking on interest rates, they have what's called a buffer. So if the rate's 6%, when we go and assess you for getting a mortgage, you're not being assessed at the rate being 6%. There's a buffer on top of that, and that keeps the banks safe as well. It keeps us all, a little bit of a buffer there in case rates fluctuate. But during COVID, the buffer was almost half what the buffer is now.
Right.
So you've got these people during COVID that are really struggling now because the rates have gone higher than what their safety buffer was initially. And that's a real struggle for people because they never thought that they'd have to make repayments
of the level
what they are now.
Yeah. Yes.
And so now, it's so much harder for people to get a home because that buffer is around 3.5% on top of the rate.
Holy shit. That's a lot.
But the banks have had to make that adjustment because they kind of fucked up during COVID where the buffer was so low and everyone was getting homes, and then they went, oh shit, people are not able to make these repayments.
Yes. Yeah. Do you reckon, obviously it's all about the crystal ball, but like, do you reckon if things start settling down in 2025, everyone keeps ramping on, maybe there's a few interest rate cuts, that they might adjust that buffer a little bit just to ease it off? Or do you reckon they'll keep that now that they've learnt the lesson?
We've seen like some lenders adjusting the buffer by like very marginally, maybe 0.5% here and there.
Yep.
But I think, without having a crystal ball, the hardest thing at the moment is inflation. Last quarter, it was still above where it should be. This quarter, it's very conflicting stats everywhere though. All the banks kind of say different things and economists have their different views as well, but it's starting to slowly come underway. But again, Melbourne Cup, we had the RBA meet again, no movement in the rates. It's not great that it didn't go up, but not coming down either. So most people are saying it'll be on the tail end of next year, unfortunately. But hey, if they can just stay the same till then, I think we're okay.
We'd be good for
just
staying.
stop going up because
just stay the same.
Because every time the interest rates go up, then the client's borrowing capacity drops down. So like, it just makes shit worse. And with now that half the land people are looking at is delayed until mid to next year, 2025. So what seems to work now, we're trying to put buffers in, but like, if they kept ramping it up, those clients won't even be able to afford it.
Yeah.
And then you're fucked.
Yep.
No matter which way you look at it, it's crazy times. And we call up with some clients that had like a whole community barbecue, and we're just spit yarning, and I was just sitting there going, and they're like, oh, thank fuck we got in, we made profit. I'm like, yeah, that's awesome. I was like, but the clientele's now said, if you actually looked at it, half of you guys here and most people might not be able to service the home that they built 3 years ago in today's market. So when you did get in, you're fucking lucky. And
so lucky.
And what's happening with, just the reality of how much demand there is for homes and shit, like the prices are going to continue going. Like it's not going to stay cheap. Do you know what I mean? So like, and like for so many people, like, oh, we'll wait for the rates to go down. We'll wait for this to go down, and then we'll, we'll go into the market, bro.
They're not going down.
Yeah.
And this is the thing as well. Yeah, realistically, everyone should have bought yesterday. Everyone says
100%.
that, should have bought then, should have bought then. So it is a bit of a why wait, because the rates aren't going down. And you've also got to remember, if for some reason the rates went down, if we said today, oh, it would be amazing if tomorrow the rate was 2%, that means that something's wrong in the economy. That means there's COVID, there's a recession. Am I going to still have my job, is what people should be saying to themselves. Fuck, if the rate's 2%, that means that something bad's happened in the economy for them to be that low.
Right.
And so could you service the loan anyway if you're not getting the same hours you're working, you're not in the same job?
Yeah. So there's so many different factors, and people just look at the one real nice thing and then expect that everything else will just roll in. Bro, you can't have the nice thing and have great benefit, great profit. You run those risks, and you just have to fucking ride it out. Get in before you get priced out.
We can't control it either.
Yes.
But the only thing you can control is timing when you do it, and making sure that you're asking the questions like, okay, how much savings do I need? How much deposit do I need? Is this bank better than this bank? Should I put money in offset? So even though we can't control the rates, we can kind of have a bit of control around our financial situation and how to go about it.
Yeah, killer.
You said a word then. I want to take a little bit of a deviation. You said the word recession. And I think people don't necessarily understand what a recession means or what a recession is. Can you give a quick 30-second summary of what a recession is?
You're pulling her on the phone.
Sorry.
Gioia the economist.
Sorry, you can decline.
I should know the exact answer to this because I actually did economics at uni. I passed, but I don't know the exact answer. There is a specific statistic that we could look up that a recession is defined by, and it's defined by the CPI of the country and the inflation levels being at a certain rate.
Okay.
Right.
So there's so much media attention around whether you're in a recession, not in a recession, in a boom, not in a boom, but it is very statistically driven. For example, there are a lot of economists that would say during COVID we were not in a recession.
Right.
Because of where CPI was for the country, because of where our inflation index was for the country. The US absolutely was.
Yes.
But it's not, you have to be pretty bad to be hitting being in a recession. And it's also around how many quarters those numbers go for as well. If it's one dip and it goes back up again, technically not. But you can't quote me on the amount of quarters. I want to say it's like 2 or 3 consecutive quarters of those figures being at an absolute bottom before we can label it the economy is in a recession.
And basically that's when shit's hit the fan. But until then, just keep rolling it out.
Yeah. Sorry, you said the word, and I know people are going to comment and be like, what do you mean by recession?
What do you mean by that? Yeah, I'll get the stats. We'll put them up.
Okay, we'll put them up.
I know, can't remember off the top of my head what the number was, but
That's okay. Okay, let's jump back in. You've answered a couple of the questions as we've chatted. So what impact do changes in interest rates have on Australian consumers, particularly regarding mortgages and personal loans? We kind of briefed over that, but let's rehash.
As the interest rate as the cash rate goes up, if the RBA puts the cash rate up, most likely banks are going to put the interest rates up. It is going to be harder to service for a loan, same as a car loan, personal loan and home loan. Because what it means is that what you're earning every day, it's not getting you as much money loaning it from the bank. The interest rate is almost considered like a risk level. Like you can't service that amount of money the higher the interest rate is because you're not going to be able to make those repayments. If the interest rate goes down, vice versa, you're going to be able to borrow some more money, which is great. Does that answer the time?
Yeah, that answers.
But the thing is like, I'd probably tack on to that, and the fact in terms of the building side, we're already 20,000 homes short for the next 2 years, right? we can't. There's not enough land. There's not enough builders. There's not enough trades to build what homes we need currently, and that's with the current rates, interest rates of where they are. So if they start dropping, all that's going to do is potentially bump up people's borrowing capacity, which is great.
Puts more people in the market though. It's,
re-entering the market. People currently are starting to realize that they are actually priced out of the property market and cannot afford something unless they do the rent vesting, where they're building a home as an investment home to use that potential rental income, because they can't service a home to live in for themselves. So all of a sudden these rates start dropping down, which is all well and cool. The property prices are the same, if not continually ramping. And now you're bringing more people into an already existing over-flooded market with such a limited supply, and you're fucked. So like you're kind of fucked on both ends.
Literally. It is. And it's a constant
scary
battle to get it right.
Yes.
In the economy as a whole, it's a constant battle to try and have that steadiness and being level. As bad as it sounds, I would say right now, given that we've had almost like the last 10 months of just stability of the rates, it's pretty good. Pretty stable.
Literally.
I know the price is still going up.
It's jarring for clients who haven't realised how much it's jumped up, or previous clients. Like we've got a couple of previous clients who built with us 2, 3, 4, years ago, who built a house and land package for 450, 500,
600.
and 600, and they're kind of back in the day, and they're kind of coming to us going, "Hey, think of getting another one. So how much do you think it costs to build something similar to what we've got now?" We're like 200 grand more, and they're kind of going, "Oh fuck."
And then they're like, "Oh shit!" With the new repayments, that's like a substantial increase. I'm like so many of them, like, "Oh, I'll pull the equity out and I'll do a investment." Okay, cool. It's going to be about 650, 700 in these areas, and then they're going, "Fuck, that's a lot." I'm like, "Well, bro, your house went up 300k."
Yes, you can't have both.
So you can't have both. You can't have both. I'm like, man, rob Peter, pay Paul. You're taking money out of there to then have into this. That will hopefully try and pay itself off with a small chip in on top. And then you've got yourself another property that you got to put the risk in. So do you want it or not? And they're just like, yeah, fuck it. All right, do it.
Yeah. And look, investment property, not giving tax advice, but it is tax offset.
Yeah.
So ideally, you want to owe as little as possible in your own OC. Lift up the one
and lift up the investment.
So, like I said, we can't control the rates, but you can kind of be smart about
where you put the money. 100%.
Who's getting the money?
Well, that's what we've done. Like, especially in the last coming years, it's like, okay, you know what? Let's just fucking run the gauntlet. Let's go hard and just grab this property, build the next one, and just go. Shit, is it a lot with repayments? Yes, but now all of a sudden, this is helping with the tax. This is helping with here, and you start building and going, holy shit, like. We can actually do this, but you got to put yourself into it first. And then now we're going, cool, we'll get rid of these two, pull some of that equity out, pay one of the other ones off, but you got to be in it to win it. You can't just sit on the sidelines. I'm going to put that as a fucking slogan. Got to be in it to win it.
It's not easy either. It's not easy.
Stressful.
And it's stressful. And, you have, if you're renting out a property and the person renting it decides they're going to leave, or in this market, you're not having those problems, but you've got to be ready for
that in the future.
Yes. Absolutely. Absolutely.
So how can the public, how can our listeners, how can anyone who does listen to the episode better understand and respond to the interest rates, the interest rate changes, and make informed decisions based on that?
Yeah, this was a really interesting question, because immediately you kind of just say, oh, well, just look at where the interest rates are, or tune into every board meeting of the Reserve Bank. But
got better shit to do.
Not that interesting. I would say the best thing to do, and I know it might seem boring, but just tune into the news every now and then, because it's not just the Reserve Bank that will make these decisions. They're not the only reason that rates are where they're at. When you're thinking about fuel prices, oil prices, the economy as a whole, if there's globally a war, how's Australia faring? All these things in the Australian economy, the unemployment rate, inflation, housing rate, rental vacancy. Just tuning in every now and then to the news, the podcast, whatever it is that you can just quickly get a few snippets of how is the country as a whole looking. You're going to get a good idea about it. If you're hearing someone saying, oh, inflation went up last quarter, bit of an alarm bell saying, wonder what the rates are going to do if inflation's gone up. Someone saying, oh, inflation's really steadied out, cost of living's steadying out. Awesome. If you hear on the news the government's bringing out a new grant to build homes, why they'd only really be doing that to stimulate people buying homes a bit more. So I think that, it can be boring, but the news is a good place to start.
But it's a hard one. That I'll counter that one because it's a really hard one, because one day, like you see it, I see it quite a bit. One day they're going to be sitting there going, for example, Perth, the housing, it's in the housing boom, this and this. And then the next day it's like, the housing's crashing. I'm like, bro,
which one is it?
Yeah, which one is it first off? And the way they're so fucking manipulative, they'll do it as a whole entirely, and they're talking about Sydney. Oh no, Sydney's dropped considerably, and it's dropped like 100K. There's still 1.6 mil average for a home, and then but WA has actually been ramping.
Yeah,
I'm like, well, how come you're not actually mentioning that we're doing quite strong in our own state, regardless of what they're doing over east? They just seem whatever seems to be a bit of a cash drought. So it's a bit of a
so true. And what's hard as well is as a country, all of our states are very independent economically.
Yes.
You know, the way they work. But the cash rate is set as an entire country. So they're taking into account all the states, which can be hard. I would say the only other one really good place that I like looking at is Financial Review and The Advisor, if you like to read. That if you're not into that, it's not going to be as interesting. But they usually have some well-rounded comments and information. They might have, an economist from CBA, one from Westpac, one from ANZ, and well-rounded comments, which is good as well. They'll have the CEO at Rewire, or someone from Australian Bureau of Statistics, some well-rounded articles. But again, it's not as interesting as other things that you could read. So.
Yeah, but it's also for like the very minute amount of clientele that might be listening and wanting that, because so many of them will just look at it and be like, I'm in a position, I'm ready to fucking do something. And some of the other ones are the ones that try and foretell and like, this was, all right, cool, go do some more research. But for the average Joe Blow that's just sitting there going, fuck, the rates are high. Yes, they are, but like, correct me if I'm wrong, 6 years ago, man, these were the rates. In the fives maybe not in the sevens, but like the high fives and shit, that's what it was. And you could only do what you could do.
Yep.
A bit more now, and the houses cost more, but everything else has become difficult as well. It's just the situation. It was great if we were all born in the 80s when everything was dog cheap and we all bought the land. So then we had it cheap, but we're not. We're here. So we just got to work with what we got.
This is what it is. I might be throwing you guys a little bit under the bus. If you don't have one, I know that
she's like,
Joy's like, go fuck yourself.
The fuck you doing?
I know I get emails from, and I don't even know how I got signed up to it. I must have inquired on buying a property from one sort of real estate company, and they send me an email every, I don't know, maybe like 3 months, and they go like property report, up by this amount percent, interest rate is this. Does We Finance do anything like that?
They've got a newsletter.
Yeah, I know the newsletter, but I don't know if that goes just to us or that can go to clients.
We do a monthly newsletter, but it is a little bit more detailed on certain bank policy and tailored to referrers like yourselves.
Yep.
But individually, what we do for clients that have already got a home loan and they've settled, we reprice them every 6 months to make sure their interest rate's good. But what we also do is every 6 months we'll send a property report, just because we can individually get that. So it's not a valuation. We can always do individual valuations on the home. It's more of just like a generalised suburb report, how their suburb's faring. We can get them from all the stats from CoreLogic so they can see, all right, this is how the area that I've built in or bought in is faring and where my price range might be. It's not to say they need to do anything with it. They don't need to cash out funds or sell or anything like that. But it just, that paired with where the interest rates are at, that's what we usually do every 6 months for clients that are already established.
That's fucking sick.
Yeah, that's cool. I didn't know.
Yeah, it just gives them, look, not many people are too interested in it unless they're motivated to buy again or sell. But it's always good to just say, all right, this is what the average 3x2 in my suburb costs and what the average 4x2 is and how many people are in there. And
that's really cool, because I don't know of many companies that do that type of shit. And that really, it's more of a, just an FYI, but you're still keeping contact with the clients, which I would love as a client. Regardless, I can just sweep it off if I don't want to, but at least I know you're still thinking of me.
Yeah, it does have to be after keys, though, I will say. So many of your clients have keys, only so we can get a well-rounded idea of that house.
Absolutely.
See, I would love that. I'd probably have a sticky beat because it's designated to my suburb. It's not like I'm reading about.
It's not a val on your house, but it's
for my suburb. Everyone's sticky beak around what's happening on a couple of streets over and stuff like that.
And some clients, when they're when they're looking at a second property and they don't know where to buy, I've had clients before be like, hey, can you compare these 4 suburbs for me? I'm not a real estate agent, but I can give them that data.
Yes.
You do what you want with
You
it.
do you, boo.
But I can give you the data and you can go from there.
Make an educated decision from there.
I can't
100%.
tell you what to do.
I've only got one question left, really, which is looking at the history of interest rates, how have they fluctuated in the last 10 years? And we just kind of briefly...
Shit, it's gone up.
Yeah. So look, it was pretty stable,
Yeah.
and then we had COVID. And in saying that though, if we went back a little bit further than 10 years, around when the grants were like 21 grand, when that got released, that was more of a stimulating the economy kind of time.
That was 08?
Yeah, that was quite a while ago,
Yeah.
and it was only for a short period of time. It was like a brief stimulant in the economy. But I think the main one for everyone was just how much they dropped in COVID and then how massively they ramped up. Having an interest rate increase every month for 12 months is wild. Like that was historically hasn't happened. Absolutely wild. So anyone that did have a house and managed to get through that on the other side, like well done, because it's insane.
It's insane. And that's the thing. It's like we had historically low rates. Like it was never that low before, the cash rate and shit like that. You know, like it dropped and it was all over the news. This is historically the lowest it's ever been. And people obviously taking advantage of it. But now that it's gone the opposite way, they've tended to forgot like, well, if you've gone so low, it has to come back up. Nothing can stay low and cheap forever.
Yeah.
Like, fuck, the economy needs to keep ticking along.
Yeah.
Whether you like it or not.
You had some good years while they were there, so you still saved
Happy
a little
days.
bit for maybe 2 or 3 years.
Yeah,
Fixed,
definitely.
great.
Yes.
But yeah, that's a question we get a lot as well, is between fixed and variable, but it's just no one has a crystal ball. In hindsight, of course, everyone would have loved to have fixed during COVID, but we didn't know what was going to happen.
Yeah. Everyone was trying to fucking survive.
First time it's really the first time it's happened since, you know, so many years ago.
And like maybe some of the older generation that had the properties, they would have probably done a lot more research and knew, all right, cool, I'm going to fix this. Is pretty cool. But like a lot of us are just like young first-home buyers. We deal with a lot of 18, 19-year-olds all the way up, you know, our average demographic between 19 to 35, right? By building their first home, maybe a second home. We haven't dealt with anything like this shit. So like how were we supposed to know? And even brokers.
Yeah, exactly.
We didn't know, like you guys didn't know what the fuck was going on. We're all trying to navigate our way through this shit show together. Fucking here we are.
I mean, I do it every day. I didn't even, I fixed at, when the rate was at, I fixed at 3.2 or 3.4.
Yeah.
And it was maybe like 3 months before December 2019, like when COVID hit.
Yeah.
But for me, that was low. Awesome. Fixing at the lowest threes. And then all of a sudden, 6 months later, it's 1.99. I'm like, you've got to be kidding me.
Yeah, fuck.
Is this for real? But I still, compared to now, I should have just fixed on that 3% for 10 years.
Yeah.
So you just never know.
How long can you fix? Is there a
That's
set
the question.
limit?
Look, the most banks will do 3 years is all around us. You know, we can get rates fixed for 3 years for under 6% at the moment, but you really got to be confident that you want to fix for 3 years. You can fix up to 5 at some, and look, you can fix longer than that, but it's case by case. As a broker or as the client, you've got to put that forward to the bank, because the big risk in that is if something like COVID happened. If I went and fixed a client for 10 years on 6% because they thought the rates were going to jump to 17%, and then they dropped to 1.9, that client's not going to be very happy.
No.
So, and the banks, they're going to be laughing. They're going to be like, this is great. But they have to cover themselves as well. As much as we probably shit on banks a bit with their rates and things like that, they've still got to do the right thing by clients. They've still got a duty of care for clients. So if you're wanting to fix for a really long time, like 10 years, there's a lot of hoops to jump through.
Yeah, okay.
Overall, that does it.
I'm gonna say it. Don't fucking do it. Like too much. Look how much has happened in the last 3-4 years. Why would you try and fix yourself onto a situation in 10 years' time? What the fuck's gonna happen then? I see the couple
and there are
years.
break fees.
Yeah,
you know? So they can be a couple of $1,000s depending how much you've got left in the term. So it's not an easy way out. And it also means that, if you do want to draw out equity from that property, or you've got it tied to another property, you're stuck. Hence the term fixed. You're fixed into it. Yeah.
What about, you know, a lot of first home buyers probably don't really understand. Let's say, you know, we'll be, you know, Maddie will give me the numbers. I'll be running them through and going, yep, cool. This is roughly what the interest rates are currently looking at. Blah 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 blah. And they're like, okay, cool. Is this fixed? like if I start the process, you can't fix a interest rate during the course of a build, can you? Yes or no? Sorry,
yes,
because it depends, but like the average is normally variable.
Average, we usually go on the variable rate. Okay. Very circumstantial and depending on the bank you go with, but the majority of the clients that like Madison would work with, I work with as well, would be variable during the build. And I think it's market dependent as well. You know, during COVID, more clients were fixing because the rates were low and they were fixing for 2 years. And if the build's taking 18 months, hey, it's not the end of the world. It's not the end of the world. So very market dependent. We can't, as brokers, we can't tell you what to do.
Oh, okay.
We can't say, hey, do this. But we can give you all the options. You can ask us as many questions as you want, and you're probably going to get a good idea of
which way
what to do.
So just rather than going direct, even though that's something that we're very big on, maybe go around when it comes to finance and just ask the questions to your broker, and they'll try and give you as much information as possible.
And that's what we're here for. You can ask us any question under the sun. You can ask, look, you can't say what would you do, but you can say, do you have a home and what did you do with your interest rate? Do you know what I mean? So we can't give advice because we're not financial planners, but we can give you all the options. And most of the time I find that when all the options are in front of a client and they understand what each option is, it's very obvious to them which one they want to go with.
Yeah, cool. Yeah,
that suits them.
Yeah, perfect. And with building, obviously, I know it's more of a Maddie question, but you do it as well. With a builder, you go ahead, you do a house land package, you go through. Do they start their repayments immediately when they sign up, or how does that work for a lot of clients that do it?
So you'll start making repayments once your land settles.
Yep.
And then what will happen, and this is where, look, building is, you know, a different case on its own. It is very different, but it's good in a way because if you're out renting, when your land settles, you don't want to be making the full repayment because you're trying to pay rent as well, or you're living with mum and dad or whatever it is. So you're going to make the repayments on just that land portion at land settlement. And then as your builder starts to invoice you for slab down, brickwork, roof cover, the bank is going to receive that invoice from the builder. The builder is going to say, hey, I want my money for slab down, for brickwork and all of that. The bank's going to pay that, and then you're going to make a slightly higher repayment because your loan's going to gradually, progressively increase.
Yep.
Once you get your keys and you move in, that's when you're going to make that full repayment.
The full mortgage repayment.
And depending which bank you go with, some banks interest only during the build, some banks are principal and interest. It
just
depends.
fluctuates.
It depends on what you'd prefer. You know, principal and interest, awesome. You get your keys and you've already knocked down some of that loan.
Yep.
But if you're paying rent at the same time, you might want to go down the interest only path. It's going to be easier for you with the cost during the build.
Until you move into that house and then you can start your principal.
Yep.
Perfect.
And there's no right or wrong. It's really just circumstantial what's best for you.
Perfect. Okay. I'm really happy with that.
So we haven't done this
Sorry to throw that one at you.
That's all right.
That was
so we haven't done this in a hot minute, but I think a summary would be good, and hopefully we'll make a good reel out of it that we'll chuck onto socials as well.
Cool.
Let's do a summary of interest rates on 30 minutes worth of conversations.
All right. We just need like short, snappy.
Just like straight to the point. Bang, bang, bang.
Okay. So interest rates are what the bank is going to charge you for loaning out a big lump sum of money from them. But they can also be what you get back for putting money into a savings account as well.
Yep.
Interest rates are determined by the banks, and they determine the interest rate based on the Reserve Bank of Australia's cash rate. The cash rate is determined on many economic factors: unemployment, inflation, where the country is sitting as a whole. If we need to grow the economy, if we need to kind of pull the handbrake and slow it down a bit.
Mm-hmm.
What else do we
Are they
about?
controlled by the government, or is it a separate entity?
So the Reserve Bank of Australia is what's called a central bank, and majority of countries have a central. You've got a Central Bank of America, you've got a central bank. This is where it gets a bit political. You can find that around, election time, things can happen with the Reserve Bank based on what's happening in the political world as well. So that is very dependent. But you've got an independent board of the Reserve Bank filled with economists, people making these informed decisions based on the government and where it's at. However, like the economy that we've got at the moment, the government is trying to rein in some of the inflation that we've got. So they use what's called monetary policy, which means looking at the RBA cash rate, looking at our cost of living, looking at the unemployment rate as well.
Yeah, killer.
Yeah.
Killer. I really like that.
Yeah, perfect.
Yeah.
That was a really good
That was
short little
fucking
snack.
bang, bang, bang.
Yeah.
I really like
We'll
that.
do a little collab.
Take me back to like my uni days, like when I was tested on this. I'm like, oh, what was that?
Well, thank you so much, Gioia, for coming onto the podcast.
That's okay, thanks for having me.
Pleasure. We plug. So let's plug We Finance first. Our listeners can find We Finance on Instagram, Facebook, TikTok, website, and just by Googling you.
Yeah.
And
Yeah.
have
All
I
the
missed anything?
socials? No.
No?
The socials.
No, that's all.
Sweet. You can find Mr Enthusiast on Instagram, Facebook, TikTok, on our website, Google, YouTube, Apple Podcast, and Spotify.
Yep.
If you guys could follow, subscribe, leave a rating or a review, it really helps us in the back end and kind of get this out to more listeners. We'd really appreciate it. And just remember, guys.
We're not here.
To fuck spiders.
That's
Fuck off.
right.
See yous.
Bye.
Bye.